The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and if it's Saturday, it means we're talking about money. There's an old saying that the stock market needs to climb a wall of worry. Goes back a long time, goes back decades, maybe a century ago when that came up. The reason people would say it is because if everything looked really good, you knew you were at the top of the market. You know, a market was born on pessimism, grew on skepticism, matured on optimism, and hit the top when it was
died on euphoria.
Died on euphoria. Thank you, Al. Yes. So in between, you had all sorts of questions about worries about this and that and so on. But I sometimes wonder about it because that was before passive investing. That's when the money managers were all active managers trying to pick stocks, trying to pick portfolios. And there weren't many computers. If there were any computers, they had a few spreadsheets, they had a few things going on, but they didn't have algorithms that were actually trading the stocks. So when you look at where we are today, gotta wonder if that wall of worry is really there. When you think about the potential for inflation, when you think about the potential for U.S. debt or world debt, when you think about the potential for a depression or a recession, or maybe all of them happening at the same time, stagflation, is that a wall of worry where things are headed higher? When you think about some of the things that have gone on, like the carry trade, actually just going back to 2007-8 with CDOs. Nobody had heard of CDOs. Nobody had heard of repos. Nobody had heard of credit default swaps. All those things were new, and
there's new ones now, Mike.
And there's new ones now.
Mm-hmm.
So what is the wall of worry? When you look at it, some of the things which actually we can see and hear about, what's going on? Private credit. What's happening with private credit?
Oh, let's explain what private credit is.
Oh, private credit is simply when you have businesses, small businesses primarily.
Small and medium-sized service businesses that don't have a lot of assets.
And
they're leveraged.
They need bank loans. Mm-hmm. But the banks say,
You're too much risk.
You're too much risk.
And so they're going to these non-bank financial institutions that'll loan them the money.
Right.
And for the investor, like maybe you and I, it looks great on paper that they're going to pay me 10 or 11% a year in income. But, it begs the question, what are they charging the business to borrow that money, to make a profit? I looked at the costs, Mike.
Yeah.
So some of these the other day. So these are mostly for accredited investors. They're trying to get a couple ETFs out there right now for the average Joe. There isn't any yet. The SEC hasn't approved them. They're charging 2%, 2.12%, I think, one of the ones, management fees. I think it was Oak Tree's charging management fees. So what do they have to charge that business to borrow their money? They got to be in the 15 to 16% range to make us have a spread.
Or even 18.
It could
19.
Yeah. To an already leveraged business.
Yep. To a business that doesn't meet the credit quality.
Yeah.
To get a bank loan.
Right. So what are we talking about? We're talking about subprime businesses.
Subprime businesses.
And if you liquidate the business, since most of them are technology and service-based businesses, what do you have for collateral on the business?
They don't have machinery.
No, they're not heavily asset businesses they're loaning money to.
They don't have buildings.
So when we talked about CDOs, credit default swaps, the new one is CLOs, collateralized loan obligations, Mike. The word securitization, everything's become securitized in a security.
Yep.
And so these markets are that were maybe a $40 billion market in 2000 is now approaching, they think in the next 5 years, $2.5 or $2.3 trillion.
In private credit alone.
Private credit, private debt, the money is flowing into these institutions, and the money is it's not slowing down. It's especially after 2008. The restrictions from Frank Dodd that were put on the banks restricted them from doing any of these things. So they all these non-bank financial institutions popped up after 2008 and flowing into these private credit.
So that they're furnishing money to the very firms which they would deny credit to.
Right, but the irony is that the big banks are in on the game. I mean, Wells Fargo and Centerbridge Capital started a $5 billion fund to do this last year. And the other thing is that the banks aren't holding the risk. They call it synthetic risk transfer.
Well, they're holding part of the risk, but the rest is the investors who are really happy to get 11%.
Right, but they're offshoring the risk of these loans. They're basically same thing like the CDO, which was basically securitizing a lot of these debt and then selling it off and then selling insurance policies that AIG held on these debt, right? So if some of it went belly up, AIG would pay the claim. Well, they're doing the same thing right now where they're securitizing these type of loans, and the banks are off because they can't hold them because of the regulations, and the bank regulations are going to get more stringent because the U.S. is adopting what's called Basel III. If you know what Basel III is, it came out after 2008. In Europe as Basel I, Basel II, and they keep refining these restrictions that banks can do. I was just reading last night that Basel I is like, I don't know, I'm going to say it's like 60 pages. Basel III is like 600 pages. Yeah. It's massive.
Yeah.
And so what the banks are doing is this synthetic risk transfer. One of them, the companies they use is one of the largest private equity firm in the world is Blackstone. Mm-hmm. And so Blackstone basically holds an insurance policy against the banks having these risks, so the bank can show that it's some sort of off-the-balance sheet transaction. They don't really have this risk on their books, so when they go to the regulators, no, we don't really holding this loan.
So going back to 2007, 2008, and the collateralized debt obligations, and what they did is they put all these home mortgages, subprime mortgages, into collateralized debt obligations. Goes back to the savings and loan crisis. When the savings and loans went out, there were no mortgages, and the government came up with ways to package a bunch of loans into Ginnie Mae's and Fannie Mae's and Freddie Mac's, and that went on through Solomon Brothers, came up with the idea of collateralizing.
Well, it was Michael Milken, right, who came up with the idea of packaging all these junk loans together. Wasn't it Milken that came up with a lot of these?
Milken was junk bond king.
I know, but he came up with the idea of some sort of securitization of these.
No, it was two guys at Solomon Brothers.
Really?
Yeah.
Okay. I know he's involved some. I read it. I'll still go look it up.
But they came up with this idea. Already it was well into the I'll get it right. I'm trying to say what I want to mean. I mean what I want to say, or whatever it is. They came up with the idea to do Ginnie Mae's, Freddie Mac's, and Fannie Mae's as ways for individuals to have the way to get mortgages. But that happened in the early 1980s. By the early 2000s, the people that originated those were long retired, and the people that understood what was going on had really departed a long time ago, and they took on a personality of their own. And the concept was, if you could package these mortgages together, you could package mortgages that added up to 105% of the total principal. So if 5% defaulted, you're not going to get hurt. The rest will cover it. And they could get AAA ratings on these things because they said, we have extra, more than is required, to pay off all these loans. So if we have 105 or 107 or 108%, whatever it is, the subprime mortgages are going to fail at 5 or 7% or 8% or whatever it was. We'll just plug that extra into the CDOs, and we'll package them together, we'll break them up, and we'll sell them into units, $100,000 units or $200,000 or $1 million units or whatever the denomination was. And they get AAA ratings because they had this extra safety factor. Only nobody figured that not only would the dentist in Cleveland or the carpenter in Scottsdale or the railroad worker in Washington would fail on their loans, and suddenly you didn't have 5 or 8%, you had 20% failures. But the thing, coming back to private credit, the banks spin that off their balance sheets, and they spin off the individual loans, but when they're repackaged, And when they're now labeled AAA credits,
As collateralized loan obligations.
it now comes back to them and they can use it as part of their collateral and
Yeah.
capital structure. And you have the same risk with private credit.
So just to go back to your CDOs, it was Milken. Milken realized that many of those bonds, he's the one who started packaging them together and creating the some of the CDOs back in the day.
Okay.
According to who's this? The Economist Review from New York University. So we can blame them if it's right or accurate.
Well, maybe I'm inaccurate. It was a long time ago. Anyway, we are coming to a commercial break. Don't go away. We're going to continue and pick this up. The stock market claims a wall of worry. There's a lot of worries out there. And will it be different this time? It's always difficult to say. It'll be different this time.
About Money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, you were mentioning the banks not holding these, using the collateralized loan obligations as collateral. And so, I mean, this is essentially how we ended up in as you said before, how we ended up in the great financial crisis.
Correct.
And how we're potentially could be going back down there. I've read a couple articles saying, the banks are at it again with these off the balance sheet synthetic risk transfer, not holding the risk, yet it's going to come back to them because somebody's going to be lending money to the non-bank financial institution. And as they democratize private credit and the ETFs get approved, where is this all going to end up?
Well, at this time, it's a lot smaller than it was with the subprime mortgages.
It is. I mean, right now there's about $200 billion in synthetic risk transfer. At AIG's height, they had about $500 billion in CDO. So it's not there yet. But they say in the next 5 years, this market's going to get to $2.3 trillion. A lot of these loans are going to reset in 2028.
Yeah.
Combine that with all the resetting that's going to happen in the commercial real estate market, there could be some risk out there.
And especially if they're growing at the rate they're growing, 2.5 trillion may be an underestimate.
Yeah.
There was a Bloomberg article that talked about investment bankers. One of the ways in which young people from a lot of colleges go is they get a job as an investment banker and they put in 16 and 18-hour days, 7 days a week to try to find clients. And you can make a lot of money doing that. But what Bloomberg said is they're seeing a number of investment bankers saying, we don't have to work as hard with private credit. And they're fleeing being investment bankers to becoming private credit generators. So they're going out to all these businesses. I've had calls at AFC and to see if we needed capital, special capital. And so I've listened to a couple to see what the terms are. And usually the terms are something like, they don't tell you the interest rate. They tell you, we'll loan you $500,000 and we want to have access to your checking account. We want to see your cash flow. They don't care about anything but cash flow. And we're going to take our money out of your account as soon as the cash is there every month. Essentially, they become the first payee of all the cash.
Oh, that's one thing about private credit. Is they're the first loan. They're the first leaner on your business.
But it's not even like the bank. The bank, you have a bank loan. You make your payments at the end of the month or the first of the month, and as long as you make your payments, you continue the bank loan. And we don't have any bank loans. But if you continue to make your payments, everything's okay. Private credit steps in from the first day of the month, and the cash that you generate all goes to them until their payment is made. It comes out before employee salaries come out, which, is that legal or not? I don't know. But they're taking their cash first. And the rates, they don't say how much the rates are, but when you sit down and figure it out, the rates run anywhere from 18 to 24%.
It's like having it's like a credit card rate.
Yeah. And if your cash flow drops off, they demand 100% payment immediately. I thought this was really interesting to do.
So, and how are you going to pay that if you're a business that's borrowing money to get to where you want to trying to get to?
And what do you do? I mean, we don't have receivables, but I know that there are companies that loan on accounts receivable, and you sell the receivables for a certain amount and generate working capital that way.
But from the investor perspective, the investor is supposedly going to get a 10 or 11% return on their money. But a lot of these are illiquid. They're locked up. That's why they're having a hard time turning them into an ETF, because your money is illiquid. There's sometimes quarterly redemption.
Mm-hmm.
But, they say that's the safe part, that you can't have a run on the bank because people can't pull their money. Like in 2008, people would go, dump the home, stop making the payments, and, or go to the bank and pull their cash out of the bank. Well, you can't really do that with this. It's illiquid.
Or Silicon Valley Bank.
Yeah, Silicon
Where
Valley
they
Bank.
had the run.
The run in the bank.
Yeah.
But you can't do that with private credit because of that. But it doesn't stop that there could be a liquidity crisis and people need money. And then what are they going to do? Like, let's say the people that buy it right now, it's wealthy people, sovereign funds, and insurance companies, pension funds are buying it. Well, if the insurance companies have, we've had 2 massive hurricanes down in Florida, and they need liquidity, where are they going to go get it if they can't get it there, and they have to liquidate some of their investments to go paste them? That could cause an issue.
Well, and we've been at conferences where people have come up and talked about their private credit investments for retail clients.
Mm-hmm.
But so back to my illustration, if you haven't got the cash to pay and they demand 100%, you don't have the money to pay unless you can borrow it on credit cards or whatever. And usually for $500,000 or $1 million or whatever it is that they've loaned, they just simply put you out of business.
Yeah, they say they're more flexible at reworking the rates if someone runs into trouble. But, then they say they're better at their loans. They make the claim that their loans are actually more secure than the bank loans before because they're more closely tied to the business, have more invested in the business. I don't know. But the other problem is when you get so much money coming into that industry, chasing, there's only so many good businesses to put money into.
Mm-hmm.
And so if you start to make, you promise your client 10 or 11%, and you start eroding underwriting standards and things to do that to make a deal, right? Figured, who cares? It's not going to have a problem till we have, if we have a prolonged slowdown, interest rates go back up because we get the second round of inflation bounces back up. That's when you're going to see a huge problem.
Yep. And it won't be just one business. These things are geared just like the subprime housing.
Mm-hmm.
They expect a few businesses to fail. And so they've built that into their schedules. They expect 1 or 2 businesses or whatever it is, a certain percentage to fail. But what happens when it becomes 10% or 20% or 25%?
Yeah.
The average life of businesses in their first 6 years, 80 or 90% fail. And a lot of older businesses also fail. And if you can't come up with the cash, it means the business fails, but that means the entire loan gets written off. If you've borrowed $500,000 or $1 million and you can't make your payment and they shut you down, what happens is it's not the 18% that gets foregone. It's the 500,000 or the million that goes away. And if that's 1 or 2 businesses, that's one thing. But if it's 20% of the portfolio.
Yeah, and a lot of these portfolios popped up after 2008. They haven't been through any credit cycles. There's been some that have been around for 30, 40 years that have been through several credit cycles. Kind of like, okay, they're not willing to take the added risk, but you got to ask yourself, all the other ones that haven't really seen it think that, money's going to be cheap forever. I don't know how they're performing. And I think by 2028, we'll know how many of those companies were really aggressive at their underwriting and put in bad loans.
And retail investors have it even worse because institutional investors will have some insight into what's going on, and they have enough invested in the individual company that's running that. Wells Fargo will have institutional clients they put into it, and they might have 10% or 5% or 8% of the total thing, and they will stay in touch with the managers. They'll have meetings with the managers. They'll keep really in touch, and they'll look at the failure rate, and if the failure rate gets to a certain point, if there's a redemption every quarter, they'll take their money out, which puts another squeeze on the private credit, because if you have somebody removing all their principal, that cuts down on the returns you have. Somebody that demands 10% out, unless you have 10% of cash, you have to start to liquidate, or you have to borrow against the borrowing, against the borrowing, against the borrowing, against the borrowing. So for retail investors, it's what I call one of those chocolate-covered hand grenades. It looks so good, it looks so tasty, but it explodes. 11% return is really great and the market is paying 3% or 4%.
I think there's I think it's still an attractive area, but I just think you need to watch who you're going to invest with and make sure that they've been through several credit cycles and that they're not too aggressive in who they're lending the money to.
Yeah.
I mean, you just don't want a fly-by-night company that popped up after 2008, hasn't really seen high interest rate.
But even at that, I think there's issues. Even looking back at the ones that have been around for a long time,
Yeah.
some of their long-term loanees, the people that they've loaned money to, are going to find a little better rate somewhere else and bail from the long-term company. And they're going to probably fill it with somebody that has less quality than they had.
You could, yeah. I mean, not wrong. It could happen. Like say, hey, this guy, yeah, you might have better underwriting standards, but they're giving us a point cheaper.
Yeah.
I'm going to go with them. And they might not have the mechanisms and controls in place at the old company that's been around for a while.
Yeah.
So, right. No, that's a possibility. Absolutely.
Anyway, for retail investors, not a good deal. We're coming to a commercial break. Don't go away. So much more to get to. So stay with us.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
Way back in 2011, I started talking about the super cycle. For a long time, I talked about it as we were coming out of the Great Recession. I talked about it once every 3 months or once every 4 months, maybe even more often than that sometimes, because the question was, are we going to continue recovering? Is the stock market going to continue to boom? And the super cycle was something that was a study done by Standard Chartered Bank, big bank out of England, and they came up with looking at worldwide GDP growth. And they said that there's times in which worldwide GDP growth happens at a much higher rate than on the average. The first cycle was from 1870 to 1913, 43 years. It was driven by the industrialization of the United States. We had a financial crisis that happened in 1874. No bailout, 30 years that were painful, just like 2008. Going into that super cycle, 50% of the people were employed on the farms. But that unemployment reached probably 20%. It was a difficult time, but we began to industrialize. And we became the powerful engine for the entire world. The United States became a world leader. London had been the financial capital. That shifted to the United States. That was the first super cycle. Second super cycle, 1945 to 1970, 35 years, driven by Europe's reconstruction, Asian exports. Business cycles were relatively benign, but there was a lot of growth in wealthy countries like the US and the UK and France and Germany. The stock market itself went from about 100 to 150 to over 1,000. It was the death of the colonial system. The European countries had colonized Africa and Asia. All that broke down during that period of time. It was also the time of the Cold War, the U.S. versus the Soviet Union, over the former colonial nations. All of that was happening. And think about it. That was a time coming out of World War II when we built the interstate highway system, when we went through a huge number of changes in demographics, lifestyles, and technology. Huge changes that happened in that 35 years. The new super cycle, they said, started in 2009 and would go beyond 2030. If you look at where we are now, we're in 2024, 2025. Super cycle, are we still in the super cycle? They said it was going to be driven by the emerging nations, the emerging countries, especially by Asia. And the winners were going to be global. They said China, India, Brazil, Indonesia, Russia, Turkey, Sub-Saharan Africa. Going to be very big risk, political and social volatility. Think about the storms that happened in the Asian countries a few years ago. Countries were going to be less transparent. They're going to be less stable. And investment was going to be more vulnerable to subject to politicians and bureaucrats. And it was going to make a fundamental shift in the balance of power. Every super cycle has had its losers and its gainers. In the U.S., for super cycle, agriculture was a loser. Industrial was a winner. Talked about that almost every quarter for
a long time.
A long time. So what's happened now? What's changed?
AI, quantum computing, nuclear energy.
But I think the big thing that happened was COVID.
Oh, COVID. Yes. All right.
Because COVID meant a lot of countries saw that their economic activity dropped off to close to zero. And they had to borrow. Worldwide debts grew to 300 trillion today for a worldwide GDP of 100 trillion. But the fundamentals are still there. When you look at the whole thing, the super cycle, what happened? How did it happen? Why did it happen? And for me, a lot of the reason is the change of countries going from poverty to subsistence to actual consumption. In 1820, 94% of the world, including the U.S., was living on the equivalent of, in today's dollar terms, of $3.10 a day. That meant people in 1820 were averaging $19 per month, $228 per year. Life expectancy was 37 years, and most people lived on the farms, which meant they raised their own food, they made their own clothing, they made their own shoes. There wasn't a right foot and a left foot. The shoes were the same, and oftentimes shoes were the same size, whether you wore a size 7 or a size 12 or a size 5. By 1870, the beginning of the first supercycle, 87% of the world was in poverty. Half the population lived on farms. In the U.S., the earnings had risen from $19 a month to $292 per month. Dinner were usually chicken stew, dumpling, mashed potatoes, biscuits, and honey. There weren't salads. Life expectancy had expanded from 37 years to 44, and people lived with smallpox and cholera, TB, yellow fever. Medical kits were essentially a black bag with saws and knives. They didn't have the vaccines. They didn't have the medication. By 1915, at the end of the first supercycle, the rest of the world was 82% in poverty. At the beginning, it was 87. 1 out of 5 people that had lived, 1 out of the population, 4 out of 5 had moved to the cities. U.S. labor was now $8 an hour. The average wage was $1,341 per month. Shoes right and left, and they were being made in factories. Foods varied, and life expectancy had gone from 44 to 53 years. And the U.S. had truly moved from poverty to middle class. But the world was still 82% poverty. 82% of people were living in subsistence. By 1945, the world was still 73%. And as we rebuilt Europe, poverty numbers continued to decline. Today, the poverty level is less than 20%. And it was a big setback with COVID. But what's happened is people have moved from subsistence to being middle class consumers. I can remember once I had a client who was sent to Tianjin, China, as plant manager for American Standard. 1,000 employees, and what they made were ceramic toilets, ceramic bathtubs, and ceramic shower stalls. And he said to me that not one of the employees had ever seen, let alone used, a ceramic toilet or a ceramic shower or ceramic bathtub. They were still, all of the employees had been using outhouses, holes in the ground. They bathed in tubs or whatever. I don't know. He didn't really identify it. But they were making toilets, shower stalls, and bathtubs. It wasn't too many years before those people had moved to owning cell phones, owning automobiles, doing their shopping at clothing stores, buying their food in grocery stores, and probably drinking lattes from Starbucks. That was a move we saw in China. That's a move we saw in a lot of the rest of the world. I once got involved in Tbilisi, Georgia, the country of Georgia, in converting a former Soviet military plant to commercial aviation. And when I went, the average monthly income was $50 a month. $50 a month. It seems almost impossible to understand that. But today, I'm sure that the income now is over $1,000 a month. Not a lot more. The average income in Russia now is $13,000 a year, which is a little over $1,000 a month, even with all the oil riches and whatever. But the super cycle is there. And even as the world struggles with the debt, the poverty level may have been reduced or may have grown somewhat with COVID, but a lot of those countries are coming back around. They're exporting, they're making products, they're coming from being consumers, and the economies of the world is continuing to grow. How long will that continue? That's a real question. Is it into the 2030s, 2040s? Who knows? But for now, it's a positive, and it's a positive for worldwide GDP growth. It's been a long time since we talked about that.
Well, the new, I mentioned after COVID, we mentioned the rapid development of COVID and the new vaccines.
Mm-hmm.
And, this transition to everything, artificial intelligence and nuclear power, I think that's finally starting to take off a little bit. It's going to be transformational.
And one of the things which contributes to growth is energy. You have to have energy.
And the world is dying. I mean, the demand for energy is crazy right now.
And it's going to continue to be crazy.
It's going to get worse. It's going to get worse
for
before
decades.
before it gets better. And you got these companies that are these tech companies that are just directly going to the source and saying, "Hey, we'll make a contract. We'll invest money for you to build a plant just for us."
So we're coming to commercial break. We'll come back to that for a little bit after the commercial break, so don't go away. It's fascinating what's going on in the world, and it has an impact for investors here in the United States. Don't go away. So much more to cover. So many things are going on in the world today. It's important to be aware of what's happening, not just on a personal level, but on an investment level. All of that has an impact. So don't go away. We'll be right back. If you missed any of this program, you can find it on YouTube, About Radio, or on our website. We'll be right back after the commercial break.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, somewhere between 125,000 and 800,000 years ago, humans rubbed two sticks together to start a fire. They used the fire for heat and warmth and cooking and light. That's how we lived 125,000 years ago. That's how we lived 800,000 years ago. But the fact is that somewhere between 1 out of 3 and 1 out of 5 people in the world today, not much has changed. Over 1 billion people in the world today live without electricity, according to a UN estimate. 500 million rely on primitive fuels like wood and charcoal for their heat, and animal dung. I mean, that's the world we live in today. But the chances are that's going to change. The world lives today with a water scarcity, lives in many parts of the world with major health problems, lives in a world where a lot of young people don't have the opportunity for education. But we're moving from a world with subsistence, in those cases, to consumption. And the most important factor in all of that growth is energy. It's the most important thing. So where is energy going to come from in the next couple decades?
You name it. No, I'm not kidding. It's right. They're not. Any source of energy is going to be developed.
Yes.
Wind, solar, nuclear, oil is still going to be prevalent for a long time. Gas, natural gas. Those are the 4 or 5 major ones that are going to continue to be developed. I think nuclear is really starting to move into that arena.
I agree. And we're starting to see different types of nuclear plants that are being developed. You know more about that than... Well,
I mean, they're developing smaller modules that they can be... The heat transfers a lot less. I mean, they run a lot cooler than the old big behemoths that you see on on The Simpsons
or Fukushima.
Yeah, Fukushima. They're a lot smaller and cheaper to put together. So there's a lot of money flowing into that industry, and the rods and everything like that, and the fuel spent is the waste is minimal, and it can't be reused. It can't be repurposed into bombs or anything like that. So the fuel, the waste is basically useless, and it's not really as harmful. What we see over here in Eastern Washington, Hannaford, there's no 60-gallon drums of fuel that you have to worry about.
It doesn't have to be buried for
They
centuries.
basically say it's harmless. It's spent. It's done. It's not putting out any more radiation, any more anything toxic after it's used.
And the advantage of nuclear is it runs 24 hours a day, 7 days a week. I mean, solar is really nice because you have the energy coming in from the sun, but at nighttime you don't generate any power at all.
In trouble. Yeah, I mean, in the nuclear, its byproducts are hydrogen and steam, because they still produce a heck of a lot of energy. But those byproducts can also be repurposed and used, and they both burn clean. And so it's it's a really, really efficient and clean energy.
And it takes a lot of capital to put in those nuclear plants.
It's not cheap.
It's not cheap.
It's not cheap, no.
But once you do the investment, the operating costs are minimal.
I think it's a much better way than building these wind and solar farms. I think it's a much better, even though it's a lot more expensive, I think it's more sustainable long term.
Well, it's going to be a combination of the solar is going to be there as well.
I think it's going to be there, but I think if they can figure out the nuclear and get it down to, cost reasonable, there's no really reason to put up, especially the wind farms. There's so many problems with the wind farm, environmental problems with wind farms, and and they're ugly. I think that.
You don't like a windmill?
No. I mean, an old-fashioned windmill's nice, but the ones I see off of Cape Cod, or when I go to Europe and see them off of, I was like, oh, geez, they just look. When I watch the British Open and I see them out there in the water in the Scottish Sea, I'm like, oh, they look terrible.
Going to Eastern Washington.
I look terrible going over. I hate that. I was like, oh,
Yeah.
It just ruins the landscape for me. Nope.
But they're efficient. They're very efficient.
People would argue that, Mike. They're not that efficient. They're costly to maintain. They've been in the oceans. They've been falling over. They're like 800 feet high, and they changed the migratory patterns for birds and whales. So whales are picking up some sort of whatever under the water sonar or whatever they call it, and it's confusing them and having a lot of problems with that. So I don't know if they're as efficient as we think they.
I know it's the energy that's generated is the cube of the wind velocity. So if the velocity increases from 10 miles per hour to 20 miles an hour, the energy created
It's triple.
no,
You're cubing it, right?
is eightfold, right?
Are you cubing it? Yeah.
8 or 16 to eightfold, my math. So for incremental increases in wind velocity, the energy created is significantly greater. But you have to have wind.
That's true.
And you have all the issues that you mentioned as well.
Yeah, I think the wind is the wrong. Solar, I like wind. I think it's the wrong direction. A lot of companies have pulled their their wind projects because they're expensive to get put into the ocean to build. I forget who it was, Siemens, that pulled out of doing the one off in New Jersey somewhere, and so.
Yeah.
I think natural gas is still a viable fuel, and I don't know why.
Well, the byproduct of natural gas is methane.
Methane, I know.
Methane degrades in the atmosphere, but it takes about 20 years to degrade. Whereas carbon dioxide never degrades. You have to pull carbon dioxide out of the atmosphere with, forest or whatever else, decarbonizing. Methane actually degrades in the atmosphere, but it takes 20 years. So,
well, then we just got to get those nuclear plants up and going.
It is. It's going to be nuclear. It's going to be solar. It's going to be geothermal.
Yeah, geothermal. Yeah.
But energy is there.
But the ones they talk about for you and I have looked at is the carbon recapture, but I can't see that being viable once they get rid of the subsidies.
It's expensive.
So expensive. It's double the cost of so you're building a gas-fired plant, okay, but if you want to do carbon recapture, it's going to cost you double to build a plant. Mm-hmm. Does it pay for itself? I don't know.
At this time, no, but who knows in the future?
Yeah, if they can get some economies of scale and bring the costs down to doing it, maybe that's the catalyst is getting more people to do it, some help with the cost in the interim, and then maybe they can lower the cost of building it.
Anyway, that wraps up for today. We will be back next Saturday because if it is Saturday, we're going to be talking about money. So much going on in the world today, so much going on happening. All of those things have an impact on investments. We hope you have enjoyed today. Thanks for being here. Have a great weekend. Have a great week. And we will be back next Saturday to talk about money. Take care. And if you missed any of this program, you can find us on YouTube Radio about money. You can find us on the website. Check us out. Check out our investment philosophy as well. You might as well.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1300, The Answer. The preceding program was sponsored by Adams Financial Concepts.